I firmly believe that all of these technologies are just going to be an accelerant. The state of the art as it relates to Sora allows you to create these really small snippets of video. And the technology is amazing in that it now understands physics, it understands interactions.
That was Adobe CEO on CNBC yesterday speaking about the AI boom. Joining us right now to talk tech and specifically stocks that he likes and doesn't like in AI. Eric Lynch, Managing Director at Sharp Investments. Good morning to you. What is your sense of Adobe, and what companies do you like and what don't you, given that it seems to be an all-in situation right now where there doesn't seem to be a lot of differentiation in terms of how people seem to be thinking about AI?
Yeah, good to be here, Andrew. Thank you. So I think we're at a kind of where's the beef moment for AI, where all the promise needs to be delivered this year. If you look at investors' reactions to several AI kind of stories in the past week, Broadcom, Marvell Technology, Oracle on Monday, and most recently with Adobe yesterday, what you're seeing is a reaction to slower growth than expected. Just to spit some facts to you, revenue growth for the S&P IT sector for 2023 was only 2%. It trailed the S&P's 5%. And so if you take out also NVIDIA's earnings estimates, which are obviously blowing it away from Q1 estimates, the IT sector's earnings growth year over year for Q1 falls from 19 to 6. So now that interest rates reductions are really off the table for the immediate future anyway, it looks like, given PPI, CPI, jobs prints, I think investors are showing a much more discerning orientation to these names. Adobe's a great company. It's had a good quarter, 12% revenue growth, 18% profit growth last night. But the issue, Andrew, is that the stock's up 80% year over year. And for all the exciting things like Firefly, this AI generative applications that they're implementing into the suite, they didn't up their guidance. And it's really not having a measurable additive imprint on the run rate. This is a business that was growing 20% year-over-year revenues from 16 to 21.
So who do you think becomes a winner? You know, we keep talking about how this is going to revolutionize the world, and I think it will in many ways. I just don't know if it all redounds to some of these companies or becomes a feature, if you will, of all of these products.
Yeah, well, I think the first derivative, obviously, are the chip makers and the hyperscalers, which we've seen that in the stock prices, NVIDIA, Microsoft, AWS, and most recently Oracle. Oracle is really guiding for 50% infrastructure cloud growth going forward, because its use case was really generative AI that it needed for its superior tech stack. So these names are all benefiting. It's the second and third derivative stories, which you mentioned, which, technology is always a competitive game. And there's this probably assumption that's not correct, that the new technology is just going to be additive. Oftentimes it just cannibalizes the existing. And that's why IT spend really year over year isn't up. And that's why Marvell and Broadcom didn't really show a lot of growth at the aggregate level, even though AI is growing nicely. So I think what investors need to do is look for businesses where the AI imprint is really going to materially grow earnings and revenues going forward, and not just be kind of a story that's cannibalizing the other tech spend.
Hey there, investors. Did you catch that CNBC video? Well, buckle up, because we're about to uncover the real winners in the AI revolution. You won't believe which companies are poised to skyrocket and which ones might just be all hype. Thank you for tuning in to InvestMinder, your go-to source for the latest investing insights. If you haven't already, hit that subscribe button to stay ahead of the game and never miss an update. Disclaimer: we are not professional financial advisors, and this content is for educational and entertainment purposes only. Please conduct your own research and consult with qualified professionals before making any investment decisions. Now let's dive into the juicy details and separate the AI contenders from the pretenders. Get ready for some eye-opening revelations that might just change your investment strategy. The AI revolution is undoubtedly upon us, and companies are scrambling to position themselves as pioneers in this rapidly evolving landscape. However, as Eric Lynch, the managing director at Sharp Investments, pointed out, we're at a "where's the beef" moment for AI. All the promises and hype surrounding this technology need to be backed up by tangible results and earnings growth. Lynch's comments shed light on a critical aspect of investing in AI-related companies. Not all of them will emerge as winners. While the excitement surrounding AI is palpable, investors must exercise caution and discernment when evaluating these stocks. Take Adobe, for instance. Despite being a great company with an impressive 18% profit growth in their latest quarter, Their stock has soared a staggering 80% year over year. Yet, even with the implementation of exciting AI generative applications like Firefly, Adobe didn't raise their guidance, and these new features haven't had a measurable impact on their run rate. This begs the question, is Adobe's AI integration truly game-changing, or is it merely a feature that cannibalizes their existing offerings? The same scrutiny should be applied to other tech giants touting their AI capabilities. As Lynch aptly stated, investors need to identify businesses where AI will materially grow earnings and revenues rather than simply being a buzzword or a story that cannibalizes existing tech spend. It's worth noting that the earnings growth for the S&P IT sector in 2023 was a mere 2%, trailing behind the S&P's 5% growth. Moreover, if you exclude NVIDIA's exceptional performance, the IT sector's earnings growth estimate for Q1 plummets from 19% to a paltry 6%. These numbers serve as a stark reminder that not all AI-related companies are thriving, and investors must be selective in their approach. While the chip makers and hyperscalers like NVIDIA, Microsoft, AWS, and Oracle have undoubtedly benefited from the AI boom, with Oracle guiding for an impressive 50% infrastructure cloud growth, the true winners may lie elsewhere. Lynch suggests that investors should look for businesses where AI will genuinely drive earnings and revenue growth, rather than relying on the assumption that new technology will be additive to existing offerings. As the AI frenzy continues to captivate the tech world, it's crucial to separate the wheat from the chaff when it comes to investing. While some companies are riding the AI wave with genuine innovation and earnings potential, others might be mere passengers on the hype train, leaving investors holding the short end of the stick. One area that warrants closer inspection is the storage industry. As Lynch pointed out, the assumption that new technology will be additive to existing offerings is often misguided. In many cases, the disruptive force of AI may cannibalize or render obsolete the very products and services that companies currently rely on for revenue. Take Marvel and Broadcom, for instance. Despite the AI buzz, these companies failed to demonstrate significant growth at the aggregate level, even though AI-related segments were growing nicely. This disconnect highlights the importance of scrutinizing a company's entire portfolio and identifying where the true value lies. Investors must also be wary of the story stock phenomenon, where companies capitalize on the AI narrative without delivering tangible results. While a compelling story can drive stock prices in the short term, sustained growth and profitability are what truly separate the winners from the losers in the long run. To navigate this AI-fueled investment landscape, it's essential to look beyond the hype and focus on companies with a proven track record of executing on their AI strategies. Businesses that can seamlessly integrate AI into their existing offerings, creating genuine value and driving revenue growth, are the ones that deserve your attention. Another factor to consider is the broader economic landscape. With interest rate reductions off the table for the foreseeable future, as indicated by recent PPI, CPI, and jobs data, investors are likely to become more discerning in their evaluation of AI-related stocks. Companies that can weather the economic storms and maintain consistent growth will undoubtedly have an edge over their competitors. As investors, it's our responsibility to peel back the layers of marketing spin and understand the true impact of AI on a company's bottom line. By doing so, we can separate the genuine innovators from the hype machines and make informed decisions that align with our investment goals and risk tolerance. While the AI revolution promises to reshape industries and create new investment opportunities, it's essential to approach this emerging landscape with a discerning eye. As we've seen, not all companies claiming to be at the forefront of AI will deliver on their promises. Separating the genuine innovators from the hype machines is crucial for making informed investment decisions. One area that warrants close examination is the enterprise software sector. Companies like Adobe, which have traditionally dominated this space, are now facing the challenge of integrating AI into their offerings while maintaining their competitive edge. While Adobe's implementation of AI-powered features like Firefly may seem impressive on the surface, investors must question whether these additions are truly game-changing or merely incremental updates that risk cannibalizing the company's existing revenue streams. As Lynch pointed out, the true winners in the AI race will be the companies that can leverage this technology to materially grow their earnings and revenues. Merely slapping an AI-powered label on existing products is unlikely to be a sustainable strategy in the long run. Investors should also be wary of the fear of missing out FOMO mentality that often accompanies disruptive technologies like AI. While the potential rewards are enticing, chasing the hype without a solid understanding of a company's fundamentals can lead to disastrous consequences. Instead, a more prudent approach is to focus on companies that have a proven track record of successful innovation and adaptation. Companies that have consistently demonstrated the ability to stay ahead of the curve, embrace new technologies, and create genuine value for their customers are more likely to thrive in the AI era. Additionally, investors should consider the broader ecosystem in which these AI-powered companies operate. For instance, the success of AI-driven enterprise software solutions may depend heavily on the adoption and integration of complementary technologies, such as cloud computing, data analytics, and cybersecurity. Companies that can effectively navigate and leverage this interconnected landscape will have a significant advantage over their competitors. Another factor to consider is the potential for industry disruption. While established players may have the resources to integrate AI into their existing offerings, there is always the risk of disruptive startups or unexpected competitors emerging from seemingly unrelated industries. Investors must remain vigilant and adapt their strategies as the competitive landscape evolves. As the AI revolution continues to gain momentum, it's becoming increasingly clear that not all companies will emerge as winners. The key to successful investing in this space lies in identifying the true innovators, those that can leverage AI to drive tangible business growth and create sustainable value for their customers. One area that presents both opportunities and challenges is the cloud computing sector. Companies like Microsoft, Amazon Web Services, AWS, and Oracle have been quick to capitalize on the AI boom, offering robust cloud infrastructure and services to support AI workloads. However, as these giants compete for market share, investors must carefully evaluate their respective strengths, strategies, and long-term viability. For instance, Oracle's recent guidance of 50% growth in its infrastructure cloud segment is undoubtedly impressive. However, investors should dig deeper to understand the company's competitive advantages, customer retention rates, and ability to fend off rivals in this fiercely contested market. Another sector that could see significant disruption from AI is the semiconductor industry. Companies like NVIDIA and AMD, which have long been at the forefront of GPU and CPU development, are now positioning themselves as enablers of the AI revolution. Their success will hinge on their ability to stay ahead of the curve in terms of performance, power efficiency, and cost effectiveness, all critical factors in the AI computing arms race. As investors evaluate these opportunities, it's crucial to consider the broader economic landscape and its potential impact on AI adoption. While the technology itself holds immense promise, factors such as economic downturns, geopolitical tensions, and regulatory hurdles could significantly influence the pace and trajectory of AI integration across industries. Moreover, investors must remain vigilant to the potential risks and unintended consequences of AI adoption. Issues such as data privacy, algorithmic bias, and the societal impact of automation are likely to come under increased scrutiny. Companies that proactively address these concerns and prioritize ethical AI development may gain a competitive edge in the long run. Ultimately, the key to successful investing in the AI era lies in striking a balance between embracing innovation and exercising caution. By conducting thorough research, diversifying portfolios, and maintaining a long-term perspective, investors can navigate the AI landscape with confidence and position themselves to capitalize on the transformative potential of this groundbreaking technology. As we approach the conclusion of our exploration into the AI investment landscape, it's clear that separating the genuine innovators from the hype machines is no easy feat. However, by exercising prudence, conducting thorough research, and maintaining a long-term perspective, investors can position themselves to capitalize on the transformative potential of this groundbreaking technology. Remember, the AI revolution is not a sprint but a marathon, and those who approach it with patience and wisdom are more likely to emerge victorious. While the allure of chasing the next AI unicorn is undeniable, it's crucial to maintain a diversified portfolio and balance risk with potential rewards. As we've seen, the true winners in the AI race will be those companies that can seamlessly integrate this technology into their existing offerings, creating genuine value for their customers and driving sustainable revenue growth. These are the businesses that deserve your attention and investment dollars. Embrace the disruption, but do so with caution. Stay vigilant to the potential risks and unintended consequences of AI adoption, and prioritize companies that prioritize ethical AI development and address societal concerns proactively. Remember, investing is not a game of chance, it's a careful balance of risk and reward, fueled by knowledge, foresight, and a willingness to adapt to ever-changing market conditions. As we bid farewell, we encourage you to continue your journey of learning and exploration. Stay informed, stay curious, and never stop questioning the hype. Only by doing so can you truly unlock the secrets of successful investing in the AI era and beyond. Until next time, this is InvestMinder, signing off and wishing you all the best in your investment endeavors.
Thanks again for watching, and good luck with your dividend empire aspirations. Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.